Hey everybody, Scott here. Hope you're having a great day. It is time to take a look at San Diego's home sale numbers through September of 2023. The numbers are softening pretty quickly, and I want to draw your attention to a video I shot a couple weeks ago where I caught a mistake in the multiple listing service that was miscounting levels of inventory for about a 5-year period. And when we corrected for that error, it showed that the market's not necessarily as resilient as it looked like it was. So I'll stick a link to that in the comments. Take a look at that because that will show you why I have turned more bearish on the market than I was 2 months ago. The data we were relying on from the multiple listing service was inaccurate. So take a look at that video and then watch this video for your update through September. Let's take a look at some charts. For today's video, I'm going to focus on the charts for detached housing, and I'll make a comparison where the attached housing is different, but they're pretty similar this month. So this first chart we're looking at here is the detached median price, and you can see after an extended run up, we had a bit of a drop last month. So we went from $1,015,000, we're now down at $995. So that is about a 2% drop in 1 month. If we look at the average, now this is kind of interesting. You see the median fell, the average stayed the same. You can tell right here. So what does this mean? It means we're selling more of the larger houses. Okay, and along with that, we sold a few more houses cash than normal, which makes a lot of sense. The thing that's hurting the market is the high interest rates. So year to date, our cash buyers are about 23% of the market. Last month, they were about 27% of the market. And those people tend to play at the higher end. So it's not unusual that we sold more of the higher end properties with interest rates so high. So let's look at the number of sales. And you can see we're really taking a bath here. This was a big drop of about 30% in 1 month. We're down 30% from last year. I always say that you track prices by, or you predict prices by supply and demand, and the demand has been strong enough to absorb the existing supply. As you will see later, that is starting to change. I think with all these interest rate hikes and various things going on in the bond market, mortgages touched 8% last month, and that appears to be the breaking point. So demand is falling pretty quickly, 30% below where we were last year. If we look at pending sales, 15%, which means we're not likely to get a whole lot better on that reduction. Looking at new listings, you can see those are falling at pretty much the same rate. We're down 29% from last year. So you would think, okay, new listings are falling 29%, sales are falling 29%, inventory ought to be saying the same. No, because the numbers are different. Our active listings are actually increasing pretty dramatically. You can see we are up 8% in active listings. So we've got demand's fallen 29% from last year, inventory's up 8%. That leads to a months of inventory, and this is the statistic that I like to watch, that is getting hitting 3. Now it's at 3 months for detached. When you look at attached, it's at 2.6. But in both cases, we're 73% above where we were last year for the attached, and we're 58% above for the detached. So that's a big jump. And let's zoom out so you can get a historical perspective. Now, the video that I shot that talked about the MLS problem, data error, all the errors were right in this period. And basically, they were overcounting inventory, so it made it look like inventory was higher here than it actually was. In reality, you should see this line coming down from about this point to here with the same wave pattern, but decreasing a little bit more each month. And so what that means, and the reason this was so important, is if we take the same time frame and look at sales price. So this is 2014 to 2019, you can see sales price was going up 10% a year. Okay, so the reason this was so important is your months of inventory was sitting between 4 and 5.5, and we were gaining 10%, which would make you think that's kind of what our market will do, because this was an extended period of time where that worked. Well, if you adjust this the way it was supposed to be reading starting from here sloping down, you really have, instead of from 4 to 5.5 months, you really are sitting in the 3.5 to probably at the peak 4.5 months range. And why is that important? Because we're sitting right now at 3 months range. But more important to me than the fact we're sitting here is how quickly it's growing. Okay, it's growing. The deceleration of the market is really fast, and so we're going to see softness before we normally would in the months of inventory level. Okay, so it'll take a little while for the months of inventory to catch up. So what do I think this means for pricing? Well, if we look here, I was not real worried all through this period where we were falling, okay? Because as I told you, it was a correction. Inventory levels stayed low, it was going to bounce back, and we did bounce back. The problem is now we're starting to come down with higher inventory levels, and the Fed has put out the fact that they're not going to lower rates in the near future. That's a bad combination for housing. Also, I'm filming this on the 8th of October. On the 6th, when the employment numbers came out, they were pretty deceiving. 350,000 new jobs. But when you dove into it, the participation rate stayed the same. I was like, well, how can that happen? Well, what happened is the net gain of jobs was 350,000. We lost 600,000 full-time jobs and picked up over 900,000 part-time jobs. So with the participation rate staying the same, what you're seeing is people lost their full-time job and had to take 2 jobs to make up for the income. So the same percentage of people that are working. So with more jobs, they had to take more jobs and they had to take them in the part-time area. Also, the biggest jump in job growth was education. What happened last month? School started. So expect that we're not going to see as rosy job numbers going forward. Losing full-time jobs, gaining part-time jobs does not help the housing market. So basically, I'm a lot more nervous here than I was a year and a half ago back here, and that's because inventory rates are higher, driven by higher interest rates, and I think we've got some job softness coming. Now, the reported numbers are going to be very different than what you're going to see here and what I'm going to tell you, because as you can see here, it says we're up 9.7% year over year, but remember, we're measuring that off last September, okay? So you're going to see positive numbers year over year for the next couple of months because 2022 kept going down until we hit January. So it's going to be reported as year over year increase, although it's month over month, it is falling. So that's kind of what you've got to pay attention to when you're looking at these numbers. All right, thank you for watching. Apologize if I am a little bit more pessimistic than normal, but I'm always going to shoot straight with you guys. If you like what you see, go ahead and subscribe. I'd love to have people watching these. If you have any questions, feel free to hit me up in the comments section, or I'll stick a link to my calendar so that you can schedule a quick call with me if you'd like to. Once again, thanks for watching. Until we talk again, be good.